Hello, this is Richard Wilson, and welcome to this short video on 11 signs that a hedge fund manager is reinvesting in their own business. I'm coming to you from Nice, France today, where I was in town to record some training videos for the hedge fund group, and I just spoke in Monaco next door at the GAME conference with about 800 people there. And it was really interesting, and while there, it was obvious that both hedge fund managers and family offices attending were very interested in knowing more about how to reinvest in their business the right way, and how to make it obvious to investors that the hedge fund manager is taking their business seriously and really reinvesting in their own business and taking it as something that, you know, is a long-term venture and not something they've set up to try to make $1 million in 1 year. So the first thing they should look for is make sure the hedge fund manager has a real office and that they're not just running the fund, you know, out of their house or their garage. You know, if somebody's taking their business seriously, then they would rent office space or have an office for their employees as their fund grows. Second thing is they have service providers. Many times people try to do their own fund administration when they're starting up, or they don't have a prime broker to start with. If they've taken their hedge fund seriously, they've spoken with people and they know they have to have certain service providers in place. They should have an auditor, they should have an accounting firm, they should have a prime brokerage firm, they should have a fund administration firm, they should have an attorney that they go to, compliance, legal expert. If they don't have those things in place, they haven't done the very basics. The next thing is team. This is the most important thing. If they've really taken their hedge fund seriously, they've invested in their team. They have people with great experience, 7, 10 plus years experience on their team, and at the very least, a very strong advisory board. Advisory boards just take a lot of work and creativity. If somebody doesn't have a strong advisory board in place, then it's really hard to believe they're taking their hedge fund business very seriously, unless they've just started up and they have great, you know, bench experience on their team. That's the only excuse I could find for not having a great advisory board in place. The next sign that someone's invested in their hedge fund is that they have training for their employees after they join. In the hedge fund industry, everybody values experience like gold until you come in the door, and then almost nobody trains their current team. That is non-sub $1 billion hedge funds. Lots of large hedge funds do train their team consistently and very thoroughly, but most hedge fund managers under $1 billion have no training systems in place for anyone on their team, which is, I think, really ironic given how valued hedge fund experience is in our industry. Next sign that someone's invested in their hedge fund is the systems they have in place, the technology, the trading systems, the reporting systems, how everything flows through the business. You can really tell if it's really segmented and not working well by how quickly people respond to requests for certain types of data. And you can just really tell if someone's reinvested in how they run their business based on the technology and the reporting and trading systems they have in place. Next few tips include having processes. All of the procedures and processes in your business should be documented so that when a new employee comes into the hedge fund, they just look at what processes are related to their responsibilities. They know how things are supposed to be done. Everything in the hedge fund business should be done systematically. Almost nothing is done only one time. There should be a process for doing everything. In this way, if you needed to replace someone on the team, or God forbid, the principal of the hedge fund dies, the hedge fund can still move on and follow its same investment process, same risk management techniques, and same capital raising strategies. Last few tips here. The level of risk management in the firm is something that takes a lot of research, hard work, and reinvestment in the business. You know, having very elementary risk management techniques just in how, you know, they choose securities is really not enough to cut it anymore. You need to manage operational risk as well as portfolio risk in many different types of ways. So if the manager is not, then that's a big sign they haven't reinvested in their own business enough. Last two tips: the research they use to make their investments, the experience on their team, how do they make their decisions, what's the quality of information coming into those decisions, and lastly, finally, is the level of quality of their marketing materials. If their marketing materials looks like a college project or a high school project, then that says one thing. If the marketing materials look like something from Wall Street coming out of Merrill Lynch or Goldman Sachs, it says something completely different. So just to review real quick, the top 10 things that show the hedge fund manager has reinvested in themselves include their office space, service providers, their team, the training for their team, their systems, their advisors or board of advisors, their processes and procedures or risk management, their research, and their marketing materials. This is Richard Wilson. Thanks for joining me. I'm here in Nice, France, and we'll see you next time.